This July ending was very different. My sister had to pay a lot of capital gain taxes. She called me and she blasted me saying, "Why did you make me pay so much taxes? Wasn't there a way to save tax?" I said, yes, there is a very well known way to save capital gain taxes, and that is called tax loss harvesting, in which you sell your investments that are showing losses so that you can adjust those losses against any sort of a gain that you would have seen during the same financial year. Let me explain that completely in this video. In very simple terms, you make profits on buying an asset. Let's say you bought a share at 100 and that share has gone up to 150. You sold it and you made a gain of 50 rupees. Congratulations. Now, on that 50 rupees, depending on whether you held that investment for less than a year or more than a year, you need to pay taxes. If it is less than a year, you need to pay 15% on the gains that you've made, and if it is more than a year, then you have to pay 10%. Remember, this long-term capital gain of 10% was actually introduced by Mr. Arun Jaitley in the budget of Feb 2018. Before that, it was actually zero. So when you calculate, the 50 rupees gains that you made will be adjusted against the loss that you made during the same financial year. Let's assume that the loss is 20. Net, you subtract 20 from the 50 and you now have to pay taxes only on the remaining 30. Right? There is a great saving that you've made on good 20 rupees. This is nothing but tax loss harvesting. You know the reason? The primary advantage of doing tax loss harvesting is nothing but saving taxes. But remember, there are certain rules. You need to keep those rules in mind so that you don't confuse and end up paying more taxes than ever. The first rule is long-term capital gain losses that you've booked can be adjusted only against long-term capital gains of the same or a different asset, right? On the other hand, short-term capital gain losses that you would have booked can be adjusted against both short-term capital gains and long-term capital gains. There are also certain rules that allow you to adjust these losses or gains against other assets. The other asset can be debt, the other asset can be real estate too. So please do use tax loss harvesting till the time government allows you to use it to your tax advantage. I've always believed that anything that looks too good to be true has its own set of disadvantages. I strongly believe tax loss harvesting has got 3-4 major disadvantages. The first one being bad behavior. This is not good behavior to sell something and buy back. Remember, we are all humans. We are all going to be psychologically impacted when we book losses. And for all you know, when you book those losses, you will never be able to gather the guts to buy that share or that particular asset back. This can lead to severe bit of capital erosion. Remember, you're here to make wealth and not just to save taxes. This exercise can actually lead to a lot of bad behavior and you may miss out on certain big winners that were right there in your hand. Be very, very careful and precise about tax loss harvesting. The second big disadvantage is volatility. What I mean by that is, in general, markets are very volatile during bear markets. And let's say you sold that share and tomorrow you wanted to buy it back. For all you know, that share price would have jumped up by 1, 2, 5%. It has actually happened with me. I sold something only to realize that I have to buy it at higher price. Again, psychology comes into play. Can you buy that particular same share that you sold at 100 at 105? Very difficult. Volatility is a key aspect that you need to keep in mind and be very well prepared when you do tax loss harvesting. The third big disadvantage is that you're just deferring taxes. Let us take a good example where you sold something at 100 and bought it back at 90. Right? You're very happy. But let's assume that the share that went to 90 actually shot up to 200. Now you have to pay taxes on 200 minus 90, while in the earlier case, you are paying taxes only on 200 minus 100. So there is an additional gain of roughly about 10 that you have made on which you have to pay additional taxes. So in many cases, tax loss harvesting is just about deferring your taxes, which is also okay. At the end of the day, any incident that leads you to defer taxes, defer costs is always good in wealth creation. And finally, one important thing which we all miss out is tax gain harvesting. Remember, there are cesses that we need to pay on the income, on the capital gain. By periodically doing tax gains harvesting, you actually can reduce your cess amount. This can be small, but we are actually talking about saving taxes. So why don't we also do tax gain harvesting? Let's jump into the final section. Should you actually practice tax loss harvesting? In my opinion, if the tax loss is huge, I think it is simply a big yes to go for it. After all, who doesn't want to save taxes? And the good thing is that taxes that you save can be carried forward for the next 7 years. So maybe this year you may not have big gains, but next year you may have. This can be useful to adjust against those gains that you made. So in my opinion, if it is worth the salt, please do it. But if the tax loss is too small, not really worth it, and if the transaction charges are way too high, then you should try and avoid tax loss harvesting. So net, take a call, which is very subjective, whether you should do it or not. And at the end of the day, if it helps you to save large amount of taxes, please go ahead and do it. Hope you like this video. Please do like, subscribe and share with all your friends and relatives. Good luck. Happy investing.